We're going to talk about like legal ways you don't have to pay taxes. And that should excite just about
everybody.
anybody.
I don't know how it wouldn't excite you.
All right. Welcome to the Investment Property Geeks of Charlotte. We are your hosts, Chris
and Jesse.
And today we're going to be talking about accounting and why it should excite you.
It excites us, in case you can't tell. That's why we're the Investment Property Geeks.
Jesse and I were talking about this episode a little bit beforehand, and I won't lie, his eyes started glazing over, and then I told a story, and he's like, oh, okay, yeah, that's actually kind of interesting.
Yeah, and when we get to it, you'll see why. I mean, there's it's like the whiffum, what's in it for me. So you'll see why accounting can actually be very cool. So
yeah, we're going to go through some like just generic stuff today at first. Some generic stuff about kind of what a property manager or you should be accounting for as your own property manager, if that's what you're doing. But then we'll kind of allude to maybe what might be coming on some future episodes and why this part is so. It's kind of like, here's how I view accounting. It's like your Scrooge McDuck. You know, I don't know if you ever saw the scene in DuckTales where like, Jesse's giving me the look.
I love DuckTales.
Oh, okay.
I'm just curious where this is going.
Well, like, wasn't that his name, Scrooge McDuck, right?
Yeah.
And he would like bathe in his money. He had like this silo of gold coins or something.
The
It's
lucky
like,
dime. Yeah, exactly.
Yeah, exactly. So it's kind of like your Scrooge McDuck and like you're counting your money and how you're going to reinvest it and like what makes sense and what doesn't. And I kind of feel like, you know, there's this other podcast out there that I used to listen to all the time called the Real Estate Guys Radio Show out of California. And they have a saying on there that is do the numbers or do the math and the math will tell you what to do. And so, you know, you can't do the math or figure out what you should do if you don't have accurate numbers. And it's not like this part shouldn't be super painstaking. It can be a little bit difficult if you're doing it on your own, or it just can be, if it's not, that's not your cup of tea. You have to have a good system for keeping track of stuff. As a professional property management company, we have systems set up that do the majority of this for us. It's still definitely some work to keep it clean on our end, but it is really important. But kind of the cool part about all this is what we'll talk about in a little bit is really the IRS has intentionally incentivized folks within the code book to invest in real estate. Like the IRS wants you to invest in real estate. And that might sound a little bit goofy, but we'll talk a little bit more about why that is now, or not now, but later on in this episode. And then really it's just going to be kind of a teaser for some things that we can elaborate on down the road. So
see, we told you it's cool.
Yeah.
We're going to get there.
Right. We're going to talk about like legal ways you don't have to pay taxes. And that should excite just about
everybody. I don't know how it wouldn't excite you.
Yeah.
So,
yeah, exactly.
Before we jump too far into everything else, we always, as always, want to thank you so much for watching, listening, and just getting involved with us. We ask that you leave us a review and subscribe. Click that subscribe button. You can go to investmentpropertygeeks.com. or email us at podcast@investmentpropertygeeks.com. We definitely want your feedback. We want to know what you're listening for, what you like, what you don't like, what we can do in the future.
Absolutely. Check us out on Facebook too. Same thing.
I didn't say Facebook.
Investment. No, you didn't. But that's okay. Same thing. Just
sorry, Zuckerberg.
Facebook. Investment Property Geeks. That's how to tune in there. Yeah, awesome. Hey, so real quick before we do get started, a quick disclosure: we are geeks, not accountants. You should consult your CPA or tax professional to find out more, anything that's specific to your situation. We will be sharing some anecdotes and common hearsay, but anything that we talk about should be validated with your tax professional. Make sure, one, that it's accurate, and two, that it's applicable to your situation, because we can't tell you what you should be doing in that regard. So you can listen, but don't do what we say. That's basically, I guess, what this is, that the disclosure's out there.
Yep.
And we kind of already talked about accounting and why it's important. Again, you want to know kind of where it's like, I mean, the accounting for your property is kind of like the gauges on the dashboard of your car, right? You kind of got to know like how fast you're going, when you're going to get to your destination, if things are working, if they're not. And then two, it just kind of gives you an idea of, as you're looking at different strategies down the road or exit strategies, it'll give you a good idea on, what you should do with that money. Because at the end of the day, like we've talked about in this podcast before, your investment is really like a briefcase full of money. And that's how you should look at it. So, try not to have emotional attachment to the house. Try to just look at it as a briefcase full of money. And your job as the investor is to grow that briefcase as much and as fast as possible. That's within your risk tolerance. So really you have to have good accounting to be able to look at like, hey, should I keep it in pile A or should I move it over to pile B? that's all we're trying to do.
There it is. Pretty straightforward.
Yeah.
So, in that vein, what does a property manager account for?
Ooh, not much. No, just kidding.
Well, that's nice.
I know.
Way to really grab their attention.
Feeling feisty.
Obviously. Chris has had a lot of caffeine this afternoon.
Mm-hmm.
Well, obviously, one of the first things right out of the gate, rent.
Yep.
Pretty straightforward. What are you doing as a property manager? Well, you're collecting rent. You're accounting for rent. You're distributing the proceeds of the house out appropriately. And that's pretty much the number one thing you're doing.
Yep. And not only rent, but you want to make sure to like any other fees that you happen to get from the tenant that you're charging, if anything, like if they break something, you repair that, you want to make sure that shows up on their ledger. And even if you're doing this on your own, you just want to make sure that you've got a good detailed record of what they've paid you. And if you got a late, like if you go to court, hopefully you don't have to go to court, but if sometime you got to go to court, one of the things the judge may want to see is a ledger. And if you don't have a ledger, you're like, well, Your Honor, I just take the cash they give me every month and gamble it away or whatever. I don't know.
Exactly.
It's going to make something up that probably wasn't appropriate, but, good luck.
Yeah. So not to belabor the point, but Chris is exactly right. Anyone can just collect rent. Anyone can go and just, take that money in and just pay their bills and not have an accurate accounting record. But for all of the reasons Chris mentioned and so many more, it's such a good practice to get into, to have a month-by-month ledger, break down your expenses, break down everything that's going on with that property so that, accurate records are going to be your best friend at the end of the day.
Yep, absolutely.
Also, repair expenses, because guess what? You own an investment property, you are going to have expenses on that property.
Absolutely, especially if you've deferred maintenance or the prior owner deferred maintenance, there's definitely going to be, but even in the best properties, even brand new properties, you're going to have repair expenses. It's going to happen.
Yeah, it's funny. Oftentimes I'll meet with people and they'll have a brand new property. Oh, we're not going to have to worry about maintenance. Well, famous last words. The first thing that happens is that dishwasher that's only 2 weeks old stops working. So yeah, it's going to happen.
Yep. And, two, just be aware, I mean, you probably talk about this a little bit, Jesse, but not all repairs are considered the same from an IRS perspective. So don't just put down spent $350 on repairs. You got to say specifically what it was for, and that kind of thing, just because it may not all be expensed for tax purposes in the current year. You may have to depreciate that out.
Yep.
And that's where an accountant's really going to be able to help you out. We'll get into that a little bit later. We can't talk too much about depreciation and how you calculate it or specific to your property, but we'll talk about depreciation in general and why it's kind of a cool thing, what it is, what it means.
Yeah, exactly. And what Chris is talking about there is capital improvements that you're making to your property versus just normal, everyday maintenance items like cleaning and yard work.
Yeah. So what might be an example, Jesse, of a capital improvement?
Putting a new roof on the property.
Yeah, absolutely.
That's a capital improvement.
Versus a repair would be like replacing a few shingles on the roof.
Exactly. And you want, and again, comes back to what we just said before, have accurate records so you know the difference. And when you go to see Mr. and Mrs. Accountant at the end of the year, they can help you.
Yep. And I will say this, sometimes TurboTax can work for some of this, but in my experience, no offense against TurboTax, have used that when I was much younger and taxes were far less complicated. But days. Do not rely on on that tax software for doing this all for you. Being able to make sure that you're claiming every penny that you can legally from a tax perspective and IRS perspective is something that is best left to a professional.
Yep.
The way I think about it is hey guys, these CPAs, they went to school for a long time and studied for a lot of hours and spent a lot of money in order to figure out how to get you to pay as little tax as possible. Mm-hmm. There's a reason they're around. There's a reason they exist, and it just hasn't all been handed over to software. It's too complicated, and every situation is way too nuanced to rely on software to do it. Not to say software can, it's just that chances are pretty good there are going to be some things that a CPA could catch if they're really good that your software program won't get.
If it sounds like this is a paid advertisement for CPAs, I mean, it's not, but we're pretty much saying work with the CPA.
Yep.
In instances like this,
and I would say don't a CPA is kind of like saying, hey, I've got this weird thing going on with my eye. Go to a family practice doc. There are all sorts of CPAs out there, and a lot of people will tell you that they can deal with real estate, but go to one that really knows what they're doing with real estate.
That's a really good point. Yeah.
like I think I've said this before, but like my son says, he calls it the eye dentist, the ophthalmologist. He's like, am I going to go to the eye dentist to get it? It's like, well, yeah, we'll talk about that later. It's too cute to not correct you, but I guess what I would say is like, if you've got a real estate related portfolio and whatnot, like don't go to the eye dentist like for it. Make sure you're going to the right professional and not just a generic CPA who's they're a one-man show. And yeah, they can technically do real estate, but their specialty is really helping small business owners. Well, it may not be what you're looking for.
Yeah. Very good point.
Yep.
So when you are going to the CPA at the end of the year, keep accurate records and bring everything with you. We talk about, having invoices.
Yeah.
Of all the work that was done on the property, even photo evidence sometimes.
Yeah, if you can. Sometimes CPA won't usually use it, but they might say you might not remember what the repair was, and so you might want to have photos. Or if the IRS ever audited you, at least you could prove that it was an expense versus a depreciable
documentation.
Document
the heck out of everything. So heck, we've all got smartphones. Grab yours out, take some photos, file it away somewhere.
Yeah, and ideally, you or your property manager is putting these expenses and income into some sort of software program where at the end of the year you can create a detailed report to give your accountant. And hopefully that's enough. Usually what we provide we give owners monthly statements, we give them full transparency and access to all the invoices that we got from vendors. But I think what's most helpful and what most owners do is they just wait till the end of the year when we send out like an annual report by property. And we just say, hey, here's all the detail on all the income you had and all the detail on all the expenses by year. And it gives like a brief summary on each expense of what it went to. And that's usually enough. But you've got more detail there if you need it. So just make sure you got something kind of like that, and that'll make life a lot easier for you than pulling out the old shoebox of receipts.
Which some people still do.
I guess so. Not this guy. There's no way.
So other things, property managers accounting for other income, any other income that's coming in either from the tenants or deposits.
Yeah, deposits is a big one, like especially to remain compliant. Like here in North Carolina, we've got North Carolina Tenant Security Deposit Act, and that has some very specific accounting requirements around the security deposit and having to place it in a trust account. And yes, that applies to DIY landlords. So if you're a DIY landlord and you do not have a security deposit in a trust account, which is not just the same thing as going to your bank account and opening up a new checking account.
Right.
If you don't have it in a trust account, or have a bond or something like that, then technically you are in violation of the North Carolina Tenant Security Deposit Act, and you should get that rectified.
Yeah, and check, if you're listening outside of North Carolina, check your state specifically to see what the requirements are.
Yeah, but most states are going to have something along those lines.
Exactly.
And then you want to make sure you have some sort of accounting of that and receipt to the tenant. And then when you do the disposition and all that, that's a whole nother thing. Like make sure your accounting's in good order so that when you do the disposition, if you ever have to go fight that in court, you have all the appropriate records. And that's where the pictures can come in handy, is you have all the appropriate records to show, hey, I actually went and did this work. This is how much it costs. Here are the invoices. Here are all the itemized expenses of the work that I did. And here's how much I billed back to the tenant and why. And if you don't have good records on that, then that becomes very difficult to do. And the burden of proof kind of falls on you as a landlord, unfortunately. So make sure that's all good.
That brings up a good point somewhat related to this. I had worked with someone previously who was managing properties, and they commingled money.
Ooh.
They put the security deposit into their regular checking account.
That's no good.
No, it's never a good thing to do. Don't do that.
Yeah.
Absolutely do not do that. It's vital. Like Chris said, most states are going to have rules and laws that are similar to North Carolina where that money needs to be kept separate. Do not make that mistake.
And just for practical purposes, like the last thing you want to do is your tenant's moving out and maybe you have like a $1,500 rental and all of a sudden you're like, hey, honey, what do we do with that $1,500 from the tenant? Oh, I spent that on Christmas presents for the kids. What?
Yeah, that's a problem.
Because that's why there are laws about commingling, right? Because It's not your money. It's not your money. It's the tenant's money. You are the steward of that money until it gets returned to them or it gets, dispositioned in another way. But yeah, don't do that.
No,
keep it separate. Put it in a trust account. Cover your assets. And if not, hire a property manager. If that's certainly I'm biased, but if that's something that we can help you with at all, we'd be happy to help you. Just keep life a little bit more orderly for you there. So
and keep you on the right side of the law too.
Exactly.
What else? Issuing owners 1099s. I don't know why I struggled to read that.
I don't know either.
I was looking right at that for like 5 seconds and it just wasn't clicking. Yes, issuing owner and vendor 1099s for tax reporting purposes at the end of the year.
Yeah, our whole philosophy with this podcast has been to make it very like off the cuff and natural, so we don't edit it at all during. But that would have been an area that I edited out.
Oh, me too. Yeah, no, me too. I was just staring. It's like I blanked out.
It's all good. It's all good. Hey, so one of the things a management company does, like Jesse said, is we're gonna send owners a 1099 at the end of the year. That's something every property management company should do. Be aware, if you are looking to hire a property management company, you may want to ask this question: are you going to charge me a fee to send me a 1099? Now, what's kind of interesting is it's something they're required to do and to give you. Some management companies charge an additional fee for that. Others are not as transparent sometimes about it, whether or not they charge a fee for that. So not saying that's wrong or bad necessarily, just something for you to be aware of. Some companies do charge you a fee. And I mean, I get it. It's a lot of work. It's an extra step. Come January, it's kind of a big pain in the tush because we all got to do it. But hey, that's part of it. But then the vendor 1099s, what's kind of interesting is, if you are we'll talk about this in a little bit, but like if you're on your own doing this, you may be subject to creating some 1099s and sending them out to vendors and the IRS and going down to the post office and sending them to the IRS on what vendors you paid, how much. Whereas we do that for you as your management company. So we do all that heavy lifting and tax filing for you for the 1099 stuff. So something to just be aware of. I used to hate doing that when I was managing stuff on my own.
Yeah, exactly. So what you account for as the owner?
Yeah. So even with a property management company, there are a few things you still need to account for because we just don't pay everything on your behalf.
You're not off the hook, so.
Unfortunately, it's really easy what you have to account for, though.
Yeah, it's much, much easier. First and foremost, taxes. You're still paying taxes on your property. That doesn't stop. That doesn't change.
Yeah, so your tax bill that you get once a year, however you pay that, then just make sure you are documenting that appropriately, handing it over to your CPA.
Yep, exactly. Continue paying your mortgage. It's surprising how many people think that, now I've got someone else coming in that's paying my mortgage. Well, they're paying you to pay your mortgage.
Right. And when you get the tax, I forgot what it's called. It's like a 1099. It's not a 1099-T. My wife's going to be so embarrassed as a CPA. But there's a form, that you should get from your bank or whoever you pay your mortgage through. Unless it's like a private mortgage, that'll tell you how much interest you paid that year. So what's really, and it should be on all of your statements too. Mm-hmm. So just make sure that you're keeping track of your interest versus principal in the mortgage, and versus escrow payments, because escrow payments are not really an income or expense. It's a cash flow thing. So that kind of gets ignored. The taxes are what's important, what actually got paid in taxes and what actually got paid in insurance. But a lot of times those are in your escrow payments, but that may not be this, what you get to deduct might not be the same thing as what your escrow payment was because of some timing stuff. But you do want to keep track of that interest because chances are very good you're going to be able to deduct that on your taxes on Schedule E. What's cool about real estate is even if you fall within the standard deduction, which lately, the last couple of years has been very large, even if you fall within like the standard deduction and you don't itemize, because you own rental real estate on Schedule E asks you to itemize all these expenses. Mm-hmm. So you still get to deduct it. So like even if you're not eligible or it doesn't make sense for you to deduct interest on your primary residence, you still get to deduct interest on your investment property. Potentially check with your tax advisor, all that stuff. But yeah, kind of cool.
Very much so. We told you we were going to make this cool.
I know. Yeah.
There we go.
Super cool. So keep track of principal and interest separately. That's the takeaway for the mortge.
Keep track of everything is really the lesson from this podcast. But yes, absolutely. Insurance. As the property owner, you are still paying insurance on the property. It's a different type of insurance now, normally.
Yep.
Versus primary residence. This is now an investment property, so you now have landlord insurance.
Yep. And the cool thing is you get to deduct insurance on your investment property. You don't get to deduct insurance on your personal or your primary residence.
There you go.
So cool.
Your HOA, if you have one, you continue to pay that monthly, quarterly, yearly, whatever it might be.
Yep.
And depreciation, you're also accounting for that. And if you don't want to do that, go talk to an accountant.
Yeah, you should, because I'll tell you what, even someone who's been doing this for a while is married to an accountant. My wife, I'm married to a CPA who used to do real estate taxes for wealthy individuals. And guess what? I still pay a CPA that isn't my wife to do my taxes every year.
Yeah.
Because it's so dynamic. It's changing all the time, and rules change all the time, and sometimes very last minute. You really want someone where that's their job, is they're paid to keep up on that stuff for you.
Yep.
To make sure you're filing correctly and getting every dime that's yours.
Yeah.
The other thing we didn't really mention, I guess, is like, your property manager will be accounting for their property management fees, but those should be tax deductible too. So like our service doesn't actually cost as much as you think it does. It costs that minus whatever tax bracket you're in. So, if a property manager, if you're like, wow, it's going to cost me, X% of my monthly rent, but I'm in a 25% tax bracket. Hey, guess what? You got a 25% discount built in. You're actually getting 75%. Or it's only costing you 75% of what that expense is, because you're going to get a write-off, and you're not going to pay taxes on that. So I don't know. That's kind of like the silver lining.
That's definitely a silver lining.
So Jesse, the next time someone asks for a discount, you'll be like, yeah, sure. What's your tax bracket? I'll give you that much of a discount.
There you go. It's a good selling point right there. But it's true, and it's a valid point. So.
That's true. Yeah. It's kind of a cool way to think about it. So property managers really aren't as expensive as maybe you think.
No.
And we really aren't. Like, no. I mean, you think about how much time it takes you to account for this stuff versus we've got a system for it. Like, if we, let me put it this way. If it took us as much time to manage a property as it takes you to manage a property, we'd be out of business.
Very much so.
Because there's no way, like, we don't charge enough money to have even the people with the least amount of training be able to do that and be profitable. The only way we're able to do this and be profitable is because we do it in such large volume and we have great systems in place. That allows us a small profit. So I guess what I'm trying to say is, like, we've said this before, it's going to cost you way more to go do all this stuff on your own if you make a decent amount of money than it would be to have someone else do it for you.
What is the value of your time?
Yeah, what's the value of your time?
Ask yourself that question.
Yep. And it's just kind of like too, like, I'll tell a story later, but we'll tell a story later about like why my CPA is worth their weight in gold. Like, they're worth way more than what I pay them, because they're going to save me a lot of money this year.
We're building up to it. Don't worry.
We're building up. It's going to be great.
Chris actually teed this up before. One thing that you want to do if you are self-managing, an important number, keep track of what you're paying your vendors and know how to issue them a 1099. Because what do we say? If it's over $600,
that's at least what the rule used to be. I'm not sure what it is now, but like, yeah, if you have someone who you have paid $600 or more, chances are pretty good you're supposed to give them a 1099, the federal government a copy of that 1099, and the state of North Carolina or whatever state you're in a copy of that 1099.
Exactly.
Did you?
Yeah, there you go.
And if you don't, or they don't give you the information, or you can't find their social security number anywhere, they went out of business or whatever, the burden is on you as the payor.
Right.
So, add that to the list of things that you get to do right after the holidays. So like, you come home from vacation, get back in the groove of things at work. Oh yeah, now I got to go file a 1099s for my rental property.
Sounds like fun, doesn't it?
No. But hey, you got to do it. So, the one thing I want to go back on, depreciation a little bit. So this is like, there are a lot of ways you can make money investing in real estate. A lot of ways that real estate is a really awesome asset class above and beyond other asset classes. And depreciation is one of those reasons. So like, I always say cash flow, appreciation, depreciation, and leverage are the four main ways you can make money in real estate that are different than most other asset classes. We could do like a whole episode on just that, like the four. Anyway, but depreciation is really important, because essentially what it is even though, we'll break it down for people that haven't ever heard of this before. So like, even though in theory over time most real estate is going to go up in value, you get to tell the federal government, or maybe the state government, that your asset is actually going down in value over time, or is depreciating. Because in theory there's some like deterioration that happens and things like that. So what you do is you like separate out the land from what's the value of the building from the land. You can't depreciate land because in theory land doesn't deteriorate over time. And then you get to depreciate the building, but not all of the building gets depreciated at the same way. And so what you get to do is you get to write off a portion of what you paid for the building every year, and you get to tell the government that that was an expense. Now, the cool thing is, and why this is so powerful, is that you didn't really incur that expense, at least not yet. You basically, so like, I guess what I'm trying to say is it's very typical in real estate investing that you could be making cash flow and putting money in your pocket, but on paper you have a loss. And it's totally legal. In fact, the government wants you to. That's why, like, they want you to invest in real estate because of things like depreciation. Like, that's how we know they want us to invest in real estate. Because, like, you know, I think it's Tom Wheelwright or something that says, like, you know, X pages of the IRS code book are for how to pay taxes, and the other 900,000 pages are for how to not pay taxes. So most of the code book is in there to tell us how to avoid paying taxes legally. Depreciation on real estate is one of those cool things. So you get to write off part of the value of the property as an expense, which if you have other investments or you're below certain income thresholds, like that could be a huge benefit to you as a taxpayer. So if you're in the 25% tax bracket, even the 10% tax bracket, or 30% tax bracket, and you have other gains, and you can write those off with a loss on paper with your real estate investing, but you actually made money or broke even with your real estate investing, that's a pretty good deal. Pretty good deal. So depreciation is really cool. We'll talk about that a little bit more, but yeah.
Which tees us up to your pretty cool story.
Yeah. So like I titled this section, like how accounting is sexy.
Well, it was until you said it like that.
And yeah, really, I mean, you know, so here, let me tell you this story. So I bought a property this year, and I was just talking to my CPA, and again, everyone's situation is different, but we put a lot of money into rehabbing the property. And recently with the Jobs Act and whatnot, there are some allowances for what's called bonus depreciation, where basically things that you normally would have amortized out or kind of spread out the cost of over several years, you can now expense all in the same year, which for some people, they might go like, well, why would you have to spread it out anyway? Well, it's because this whole idea that like you don't use it all up in the first year. So if I put in a brand new refrigerator, the government is basically saying like, hey, that fridge is going to be good there for several years, so you don't get to expense it all in 1 year. You kind of have to expense it over the several years it's going to be in service at the property. But anyway, so we put in a bunch of repairs into the property this year, which those repairs, some of which were actually financed. So like the way we did this investment is we had a loan for the purchase price, but then we actually were able to get financing above and beyond the purchase price that covered some of the repairs. So like I financed some of the repairs. So it wasn't even money out of my pocket to go do the repairs. But now we did like, I don't know, it's somewhere in the ballpark of maybe 30 grand in repairs on this property. Plus my accountant is going to do something called a cost segregation analysis, which is basically, not all accountants will do this. In fact, I find it's kind of rare to find one to be able to do this. So we're going to try to get them on the show and talk a little bit more about this. I have to be careful how much I go into, but basically what it does is it breaks out the different components of your property to allow you to expense things faster, so that you can deduct things faster. So instead of having to wait 27 and a half years to get all of your tax benefits out of the property, you can get a huge benefit up front and then the rest of it over time. So long story short, on this property that I invested, yeah, sure, I put an additional 30 grand worth of stuff into, maybe 20 grand of it was financed, so it wasn't even my money. So I'm out of pocket like 10 grand. I get a write off probably $50,000 or $60,000 this year. Now, again, I'm going to say something that is like consult your real estate or your tax professional, but there's this whole concept of active versus passive losses. So depending on your income threshold and how involved you are in real estate, you might be able to write all that off or you might not. You might have to have some other gains like investment gains like in stocks and things like that in order to be able to write off. But long story short, it's still your write-off that you get to keep and you can always carry it forward, I think. So it's kind of cool because I'm an active professional in real estate because of what I do for my day job. And so I get to offset that against my income. That's huge. So Jesse and I were talking about earlier, you know, some folks are like, well, I would rent my property and it sounds like a good idea, but you know, the rent is going to be less than the mortgage because they just bought it or something. They didn't think about buying as a rental. So they're going to lose, you know, maybe lose, quote unquote, air quotes, even though the tenant's still paying the mortgage for them. They're going to be out of pocket like $100 a month. Well, if they've got something like this, right, where I'm not saying everyone can do this, and this might be a limited time, and with new administration changing and everything, you know, tax laws may change. It's always changing. But long story short, there's probably a tax benefit in there somewhere, and this could be huge. Like if you're in the 25% tax bracket and you get to write off $60,000 in year one, that's $15K to your pocket. Do you really care that you're losing $100 a month when really the tenant's paying the mortgage anyway? So you're not really losing $100 a month because they're actually paying down the balance on your loan too. Like that's where this starts. Like you can't just look at the investment as, you know, how much money is going to go in my pocket each month. You have to look at the big picture.
Yep.
And how much money goes in your pocket each month is really important and it's part of it, but it's certainly not the whole picture.
Yeah.
So just make sure you're looking at the whole thing.
Increasingly, those are the conversations I'm having with anybody who's like weighing out options. Say, you know, do I want to sell? Do I want to rent? Well, let's consider, you know, all the options of both. And Chris just brought up so many good reasons why renting could be advantageous for you. Don't just think about the short-term gains. It's easy to do. We're human. Everybody like chases after the almighty dollar or getting a couple extra bucks in your pocket if you were to sell right now, or I want to maximize how much money I can get month over month. But think about all these other things Chris is talking about because it really can be advantageous for you in the long run. Yeah,
absolutely. And I think in future episodes, you know, we'll expand more on how the tax law is really designed for real estate investors. It's, I mean, not just real estate investors, but it really incentivizes real estate investors. Mm-hmm. And there are a couple other things in there, like, you know, you can expense items related to investment. So again, consult your CPA, but like maybe if you say had to drive out to your property or you had to buy something for your property or whatever, those are all things that might be able to be expensed that maybe they're like more personal in nature, but you can kind of find a way to justify and say it's a business related expense for your investing. That's also a potential tax benefit that you could have that you wouldn't have just by having a day job. So it's kind of a cool way to have some additional tax benefits. You have to use it responsibly, make sure, you know, you're consulting with your tax advisor. And then the other thing that I really love is, you know, you have this appreciation, but you have this thing that's out there in the tax code called a 1031 or a Starker exchange. And for those who aren't familiar with it, is basically if your property appreciates over time, right? At some point when you sell, anytime you sell an appreciated asset, the government considers that income. And the government always wants to tax you on your income. So typically those gains, like capital gains rates, are lower than typical like earned income rates. Not always, but typically. So the cool thing is there is tax law out there that allows for a very specific process that you have to go through, but for you to indefinitely defer any taxes you would have to pay on gains when you sell a property. So that's huge. If you take out a loan for $200,000 on a $200,000 property, maybe you paid $40,000 for it cash. And after 30 years, you've not only have now a $200,000 property that you own outright, but it's probably grown to be maybe $500,000 in value. Essentially, you've made not only the cash flow off of that and the tax benefits that you've gotten while you've had the property, but you also got another $460,000 that now the tax man in any other asset class would want a piece of. There's a way for you as a real estate investor to basically take that $460,000 and not have to pay a cent to the government. And that makes your investment of $460,000 really worth probably like $750,000, because if it was any other asset, it had to be $750 in order to bring it back down to the $460. So that's the power of real estate investing. And so that's why it's so important when you're looking at this and you're doing the accounting, you're not just looking at like, hey, I might lose $100 every month on my mortgage. You got to keep the big picture in mind. And that's how people build wealth. It's, you know, flipping houses is great, but you got to hang on to them to build wealth. You can only flip so many houses a year, even if you're a machine. It's still a job. And so this is where buy and hold real estate is really where you look at anyone who's built massive wealth, and buy and hold real estate is almost always a part of their portfolio. And this is why. This is the secret. And if you're only looking at the dollars and cents on the surface, you're missing what everyone else knows, which is there's so many advantages in the tax law and how you do the math. And that's why people who give up so early and they want to sell their property, I'm like, no, like, not just because I would love to keep managing it, but like you're getting the tip of the iceberg in benefit.
That's it. Yeah.
Yeah.
Which is exactly why, tying this all together, we said this was really cool.
Yeah. Really awesome. I mean, and that's the way to look at it. It's like, yeah, do you want the tip of the iceberg or do you want the whole iceberg? And it doesn't mean you have to hang on to every property forever. No. There's ways to evaluate that and do the math and figure out what you should be doing. But the point is, like, there's so much benefit to the buy and hold, in so many ways. Like, make sure when you're doing the math and you're doing the accounting and you're trying to figure out what your best options are, make sure you know how to do all the math together. And if you want help with that, we love to geek out. We'd love to help you.
Absolutely. Absolutely. And if nothing else, as we've said multiple times throughout this podcast, consult with your CPA, because your CPA can be your best friend in this instance.
Absolutely. But don't make it your iDentist CPA. Make sure it's a CPA that really knows what they're doing with real estate and is willing to take a stance that's aggressive enough that you feel comfortable with, but not too aggressive. Because not all CPAs that do real estate taxes are willing to do, like, say, the cost seg that I talked about earlier.
Exactly. Do your homework. Find someone that's the right person for you.
Yeah, exactly. Awesome.
With that, I think that's it.
Yeah, pretty much. Until next time.
Yeah, until next time. We appreciate you guys listening, watching, subscribing. Don't forget to subscribe if you haven't already, and leave us a review. We really do appreciate that. And as mentioned earlier at the beginning, we want as much feedback as we can get for how we can, help you by sharing topics that are important to you and covering things on this podcast that might be of interest. In the meantime, this is Jesse and Chris wishing you a brighter life through real estate. Take care.